Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
All right, so let's just dive right in. Friday, January 16th, 2026, the closing bell rings, and Mara Holdings, it settles the session at $11.36. Now, that's a 6.6% intraday gain. We saw, 51.47 million shares change hands, which is a significant volume surge, roughly 25% over the average trailing session. And what makes this really fascinating is that it happened in a complete and total vacuum of news. There was no earnings release, no new energization announcements, and Bitcoin itself was effectively flat, hovering right around the $95,328 mark.
It was a textbook sympathy rally. I mean, when the sector moves, the highest beta names move the hardest, regardless of the underlying reality.
Or it was the market finally waking up to the sheer gravity of the asset base here. I mean, we are looking at a company that has effectively become a leveraged Bitcoin ETF with a massive industrial-scale power operation attached to it. The market is starting to price in the energy-to-value pivot. That 1136 close isn't just noise. It suggests traders are finally rejecting the bearish thesis that has pinned this stock down for months.
See, I think you're reading tea leaves that just aren't there. When you look under the hood of that Friday session, and I mean really scrutinize the order flow, you don't see high conviction accumulation by long-term institutions. You see beta chasing. You see algorithms grabbing a high volatility proxy because they don't want to hold the underlying commodity over the weekend. The fundamental reality of Mara, specifically the glaring efficiency gaps and the chronic dilution, well, that didn't change just because the stock popped 6% on a quiet Friday afternoon.
I see why you'd say that looking at the minute-by-minute chart. But let's zoom out to the quarterly view for a second. The thesis for Mara Holdings has evolved, and I don't think the bearish view has caught up to the new reality. We aren't just talking about a miner anymore. We are talking about a diversified digital infrastructure conglomerate. In Q3 2025, they hit 60.4 exahash per second energized. That is a 64% year-over-year increase. They've absolutely smashed their 50 EH's target. And then you have the Treasury. They're holding approximately 53,000 Bitcoin. That is a fortress balance sheet. When you combine that operational scale with the Treasury, and you see technical support holding firm at that 1111 high-volume node, it looks less like beta chasing and more like a hard value floor being established.
A floor? See, I come at it from a completely different angle. You mentioned the 60.4 exahash, and yes, that's a big, impressive headline number. But in this scheme, specifically in the post-halving era we are living in, scale without efficiency is just a faster way to burn cash. Mara's fleet efficiency is sitting around 20 joules per terahash. Now, for the listeners who might not follow the engineering specs closely, that number represents how much electricity it costs to produce a single hash. Lower is better. It's like miles per gallon, but, in reverse. And when you compare Mara's 20 JTH to the industry leaders who are deploying S21 XP units, they're running at 15 to 17 joules per terahash.
But is that 3 to 5 joule difference really enough to break the thesis, though?
Absolutely. At the gigawatt scale, that difference is massive. It represents millions of dollars in excess OPEX. It means Mara's break-even price for Bitcoin is thousands of dollars higher than its competitors. And regarding that fortress balance sheet you mentioned, let's be honest about how it's being funded. It's being funded by shareholder dilution. The market structure here is incredibly fragile. You have management stopping monthly production updates in favor of quarterly reporting starting Q4 2025. In this sector, silence is rarely bullish. When you stop telling the market what you're mining every month, it's usually because you don't want them to see the volatility or the downtime. That Friday rally was sector sympathy, plain and simple, masking a very precarious setup.
I think focusing purely on the joules per terahash misses the forest for the trees. You're analyzing Mara as if it's still 2024. The most compelling argument for Mara right now isn't just the Bitcoin mining, it's the aggressive move into AI and high-performance computing to mitigate that exact cyclicality you're worried about. This isn't just a narrative. It's a strategic pivot that justifies the valuation.
The AI pivot is the narrative, sure. It's the buzzword du jour for every miner that's struggling with margins. But let's look at the actual execution.
The execution is happening, and it's happening at a scale peers can't match. Look at the MPLX partnership. This isn't some small hosting agreement for a few server racks. They've signed a letter of intent to supply natural gas for up to 1.5 gigawatts of power in West Texas. And the key phrase here that everyone seems to gloss over is behind the meter.
Which implies what for their bottom line?
It implies everything. It means they're generating their own power on-site, bypassing the grid connection. This is crucial because it insulates them from grid congestion charges and transmission fees, which in the ERKT, the Texas market, can spike wildly. They are securing the low-cost energy that is the lifeblood of both mining and AI compute. And they aren't just building the shell. They acquired the majority stake in Exion, the EDF subsidiary. That gives them immediate intellectual property and operational experience in enterprise-grade AI cloud infrastructure. They've already deployed the first proof-of-concept AI inference racks at the Granbury data center. This is a tangible, physical transformation from a pure-play miner to an energy and compute provider.
That's a compelling argument on paper. I'll grant you that. 1.5 gigawatts is an enormous amount of power. That's nuclear reactor scale. But have you considered the capital intensity required to make that a reality?
Infrastructure is always expensive, but the payoff is decades of cash flow.
But AI infrastructure is a different beast entirely from plugging in ASICs. You're talking about filling that capacity with AI-grade GPUs. An ASIC costs a few $1,000s. An H100 or the newer Blackwell GPUs cost tens of thousands of dollars each. The capex required to build that out is astronomical. This is why JP Morgan analysts are so skeptical right now. They view Mara as having a much harder path to monetization compared to its peers, because they're doubly burdened. They have the legacy fleet retrofit costs to fix that efficiency issue I mentioned earlier, and they have this massive new bill for AI expansion. They're trying to pivot a massive ship in a narrow canal. The Exion acquisition is interesting, but right now it's a capital sink. You're promising future AI revenue while the core mining business is bleeding efficiency.
I think the market is discounting the mining business too heavily, though. Even with the efficiency concerns, if we look at the peer comparison, the valuation gap is stark. Mara is trading at a market cap of roughly $4.2 to $4.3 billion. This is a company with over 60 EHs energized. Now compare that to Riot Platforms, RIOT. Riot has about 38.5 EHs deployed, yet they traded a premium valuation of 6.4 to 7.2 billion. That is a massive disconnect. Mara is being priced as if the mining operations have negative value once you back out the Bitcoin treasury.
But there is a valid reason for that premium, and it's not just market inefficiency or traders being irrational, right? Riot owns Rockdale. They own the infrastructure, and crucially, they have a massive power trading desk.
You mean the curtailment credits?
Exactly. It's structural alpha. When power prices spike in Texas, Riot shuts down mining and sells power back to the grid, often making more money per megawatt hour than they would have mining Bitcoin. It hedges their downside. Mara historically rented more capacity, which hurts margins and leaves them exposed to those price spikes without the benefit of selling power back. And if you want to talk about valuation, look at CleanSpark, CLSK. They are the efficiency benchmark right now. They have a $3.4 billion cap, but they consistently report high uptime, and crucially, they sell their production to fund growth. They avoid the massive dilution drag that Mara's shareholders suffer from. The market pays a premium for operational reliability and non-dilutive growth. That's why you're seeing analyst targets for Mara drift downward. Piper Sandler is down to 16, JP Morgan is at 13.
But you also have Compass Point at 30 and H.C. Wainwright at 35. The street is divided.
True, but the trend is your friend, and the trend in targets is lower. The $30 and $35 targets are looking increasingly like outliers from a different market regime, back when we thought transaction fees would stay permanently elevated.
I'm not convinced by that line of reasoning because it ignores the optionality of the Treasury. Mara's strategy is HODL. CleanSpark sells. If Bitcoin runs, Mara's book value expands exponentially compared to CleanSpark. It's a high beta play on the asset itself. But let's talk about that dilution drag you mentioned, because I think you're missing the setup for a potential squeeze. The market structure right now is a powder keg. We have short interest sitting at 27.45% of the float. That is incredibly high for a company with this much liquidity.
It is high, but high short interest isn't always a bullish signal. Sometimes the crowd is right. Sometimes a company's shorted because it has structural problems.
In this environment, with Bitcoin hovering near all-time highs, that short interest acts as rocket fuel. If Bitcoin makes a move toward $100,000, those shorts are trapped. We are seeing call walls at $15 in the options market.
Can you explain call wall for the listeners who might not trade options actively?
Sure, a call wall is a price level where there is a massive concentration of open call options. Market makers, the dealers who sold those options, are effectively short the calls. As the stock price approaches $15, those dealers are mathematically forced to buy the underlying stock to hedge their exposure. It creates a self-fulfilling buying pressure loop. If we break through 15, the forced covering from dealers plus the forced covering from a 27% short float could drive a massive vertical move. That Friday rally of 6.6% on no news, that smells like nervous shorts starting to cover. The market is positioned too bearishly against a company holding 53,000 Bitcoin.
I'm sorry, but looking at the shadow market data, I just don't see a squeeze setup. I see institutional distribution. You have to look at the dark pools.
Dark pools are just off-exchange trading venues. It doesn't inherently mean selling.
Context matters, though. 45.14% of Mara's volume is occurring off-exchange right now. When nearly half the volume is hidden in dark pools on a stock that is trending downward over the last year, that is a classic sign of institutions unloading size. They use dark pools specifically so they can sell millions of shares without crashing the lit price immediately. They are using that liquidity to get out, not to get in. If they were accumulating, you'd usually see more aggressive buying on the lit exchanges to signal strength.
Dark pool volume can be interpreted in multiple ways, including hedging strategies or block positioning for a move up. I don't think we can definitively say it's all selling.
Perhaps, but combine it with the insider activity. This is the most damning piece of evidence for me. You have the CEO, Fred Thiel, the CFO, Salman Khan, and the chief legal officer, Zabi Nawad, all selling shares. Zabi Nawad sold 30,000 shares in November. There has been 0 open market buying by insiders in the last 3 months. If the stock is so undervalued at $11, and if they have this amazing AI pivot coming that's going to change the world, why isn't management buying it with their own money? Instead, they're filing shelf registrations for ESOPs and hitting the ATM, the at-the-market offerings, constantly. They're diluting shareholders to keep the lights on and selling their own personal stakes. That tells me they don't believe in the squeeze thesis.
Insiders sell for many reasons. Tax planning, diversification, estate planning. It's not always a vote of no confidence. I think relying too heavily on insider sales misses the broader macro picture that equity traders are pricing in. Equity traders are forward-looking. They're buying Mara now because they anticipate the Bitcoin breakout that drives the whole sector higher. They are buying the leverage.
But are they right about the breakout? This brings us to the correlation with prediction markets, specifically Polymarket. This is where the divergence trade gets really interesting. You have equity traders bidding Mara up, assuming a breakout is imminent. But if you look at Polymarket, the traders with actual skin in the game on Bitcoin's price, people betting directly on the outcome, are betting the opposite.
Prediction markets can be wrong just like equity markets. They aren't crystal balls.
True, but the signal is stark. Polymarket bettors are currently assigning only a roughly 27% probability of Bitcoin breaching $100,000 in January. More importantly, there's a 61% probability priced in for a lower for longer scenario extending into 2026. Mara is priced for a Goldilocks scenario where Bitcoin rips past 100K and stays there. The prediction markets are explicitly saying that is unlikely. And remember, Dow Jones is now integrating Polymarket data directly into their terminals. Institutional investors are seeing this divergence on their screens right now. They see Mara priced for a moonshot and the underlying asset price for stagnation. That creates a ceiling on the stock.
I would frame that differently. The divergence suggests that equity markets are identifying value that the prediction markets haven't caught up to yet. Equity investors are looking at the 1.5 GW pipeline and the 53,000 BTC and saying this is mispriced. The prediction markets are focused purely on the spot price of Bitcoin, not the enterprise value of Mara or its transition to AI.
But Mara's revenue is tied to that spot price. You can't separate them yet. If Bitcoin stays flat and global difficulty rises, which it is relentlessly, Mara's margins compress further. They earn less Bitcoin, and the Bitcoin they hold doesn't appreciate.
And that's exactly why the AI pivot matters. It decouples them from that single variable. But let's step back and look at the setup right now. We're at $11.36. We have a technical floor at 11.11 that is held firmly despite the bearish sentiment. We have a company that has secured massive power capacity in a world that is starving for energy. While there are risks, the risk-reward ratio here is tilted to the upside. The market is overly focused on the rearview mirror efficiency numbers from last quarter and ignoring the windshield, which shows a massive infrastructure play.
That windshield is foggy at best. You call it an infrastructure play, I call it a value trap. You have a company with 20 JTH efficiency in a 15 JTH world. You have management that hides monthly data and sells their own stock. You have a massive reliance on dilution to fund these grand AI ambitions, and you have a prediction market signaling that the macro tailwind you need, Bitcoin at 100K, isn't coming anytime soon. If that 11.11 support breaks on high volume, there is very little stopping a test of the 895 lows.
And I believe that if we see any positive movement in Bitcoin, that $15 call wall gets taken out and the short squeezed validates the bulls. The divergence between the equity price and the prediction markets is going to resolve one way or the other very soon.
On that, we agree. One of these markets is wrong. Watch that 11.11 level. That's the line in the sand.
Indeed. We'll be watching.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.